You sensed it, didn't you? That instant when silver seemed like it was ready to tear the ceiling apart. Then suddenly, without warning, the floor gave way. Not because the world abruptly stopped needing silver, not because demand disappeared overnight, but because the operators of the casino reached beneath the table and rewrote the rules while the hand was still in play. Here is exactly what took place. Silver began pressing into the mid-80s. Buyers were leaning forward. Momentum was forming. And the market was moments away from proving one simple thing. The paper shorts were losing their grip. And then an emergency notice crossed the wires from the primary futures exchange that controls precious metals trading in the West. Dull to read, lethal to ignore. The kind of document most people scroll past, and the kind of document that can shift billions with a single sentence. Effective immediately, the exchange modified how it calculates margin for precious metals contracts. Rather than a fixed dollar amount, it switched to a percentage of the contract's notional value. For silver, that percentage settled at 9%. That sounds harmless until you convert it into real dollars. With silver near $85, the cost to hold a single contract jumped quickly by thousands overnight. If you were long on leverage, you suddenly faced the same ultimatum every time the system feels threatened. Add cash. And right on cue, the chart responded exactly like it always does when the house pulls that lever. The moment the news hit the terminals, silver snapped lower, sliding from the highs into the low 83s within minutes. The red candles looked violent, ugly, and perfectly timed to manufacture fear. The headlines you'll see next will say the rally failed. They'll murmur bubble. They'll claim the fever broke. But here's the part you have to study closely because it changes everything. The smash didn't hold. Silver didn't collapse the way it did during previous squeezes. It didn't unwind into a multi-day waterfall. It dipped, printed a long wick, and buyers stepped in as if they were waiting for that precise moment. The price attempted to break, and it refused. That isn't weakness. That's a market telling you there is genuine demand beneath the paper games. So ask yourself, if the exchange fires a major weapon, raising the toll to participate, and the best it can achieve is knocking silver down a couple of dollars before it is bought straight back, what does that say about the force pushing in the opposite direction? It says the buyers appearing now are not tourists. They are not merely chart chasers. A margin hike crushes the leveraged speculator. It does not frighten a cash buyer who actually needs metal. If an industrial user needs silver for electronics, solar, medical equipment, or batteries, they are not sitting there calculating margin requirements. They are calculating production schedules. If the price dips, they buy more because it is cheaper input. You cannot margin call a factory. And that is why this rule change is such a loud signal. When the system is confident, it lets the market breathe. When the system is cornered, it tightens the leash. The margin hike was not about risk management. It was about stopping a stampede. It was about draining liquidity from the long side to force selling pressure at the exact moment silver was trying to break higher. Now, before we go deeper, quick side note, because many of you asked for more real-world stories, not just charts, if you're into silver-related success stories, how ordinary people positioned, early stayed patient, and turned that patience into life-changing money. There's a link in the description to a separate channel that focuses on those case studies. If that's your thing, check it out and subscribe over there too. Back to today's timeline. Because the margin move was not the only sign of panic. While the exchange was scrambling to cool the paper market, something else was unfolding above the trading desks, something political. Reports emerged of an urgent, unscheduled conversation among top finance officials from the most powerful Western economies. Officially, the subject was securing and diversifying supply chains for critical minerals. That is the kind of phrase that sounds like sleepy bureaucracy until you examine the timing. Because this did not occur during a quiet week. It happened during a silver spike with premiums flaring, inventories draining, and the physical market showing stress. When governments suddenly start using the phrase critical minerals, they are not talking about jewelry. They are talking about national security and industrial survival. They are talking about the materials you cannot build the modern world without. And silver sits right in the center of that list, whether the public is informed or not. Think about what silver truly is in 2026. It is not just a shiny coin. It is the best conductor used at scale. It is inside electronics. It is inside power systems. It is inside military hardware. It is embedded in the infrastructure of modern life. If supply tightens hard enough, production lines do not just become expensive, they can stop. So when you hear officials talking about securing supply, the translation is simple. They are worried the flow is breaking. When you hear diversifying, the translation is even simpler. They are worried the supply is controlled by rivals or controlled by markets they do not command. And this is where the story becomes uncomfortable because it exposes the real conflict. The paper market wants control. The physical market demands metal. When those two collide, rules change. The exchange tries to cool the price with margin increases. That is the financial response. Meanwhile, governments talk supply chains. That is the political response. And the political response matters more because it hints at what comes next if the shortage deepens. Prioritization, allocation, rationing. Soft at first, then harder. If a manufacturer needs silver to keep a grid project alive, and a defense supplier needs silver to keep systems running, and ordinary people want silver as a hedge against currency decay, who gets priority when supplies are tight? That question is the cliffhanger sitting behind every boring policy meeting. And it is why you cannot dismiss this as just another trading day. Now, let's talk about why the margin attack did not work the way it used to. In the past, when the exchange raised margins, the market often cracked, leverage came off, forced liquidations cascaded, and the price collapsed far more than fundamentals would justify. The system relied on one thing, a unified global price where paper selling in the West dragged down the entire world. But that unity is fracturing. Right now, there is a growing gap between what paper claims silver is worth in Western futures and what real buyers are paying in markets that care more about delivery than leverage. When the East is willing to pay meaningfully more for physical metal, it creates a hard floor under the Western paper price. Because if the paper price is smashed too low, arbitrage becomes irresistible. Here is the mechanics. If the West pushes silver down aggressively while the East maintains a higher physical bid, you create instant profit for anyone who can source metal in the West and deliver it where it is valued more. The wider the gap, the faster the metal drains. And when metal drains, the paper game becomes more dangerous because paper promises still need real inventory behind them, especially during delivery windows. This is why every smash is becoming more fragile. It can still produce frightening candles, it can still trigger stop losses, it can still shake out weak hands. But it also puts silver on sale for buyers who do not care about the narrative and who have the cash to take advantage. And today, the vault numbers tell a story the candles cannot conceal. Depository reports showed meaningful withdrawals across multiple facilities, large portions of silver leaving the system, metal that was counted, sitting there, available, and then suddenly gone. The most critical category is not just total ounces, it is the deliverable pool, the inventory that can actually be used to satisfy immediate delivery demands. When that shrinks while price is being smashed, it is the market shouting that the manipulators are losing the physical battle. So the exchange hikes margin to protect the shorts, but the lower price invites more physical buying. That physical buying removes inventory, and the tighter inventory makes the shorts even more vulnerable. It is a loop the system hates because the tools it uses to win can begin to backfire. Which brings us to the next move. If they cannot stop demand, they try to limit access, and we are already seeing it in the most ordinary everyday places. Large retailers that previously sold silver freely have begun implementing purchase limits. Consider how abnormal that is. In normal capitalism, a product that is flying off shelves gets restocked and sold again. Limits only appear when supply is constrained, restocking is uncertain, and the seller is trying to prevent a complete wipeout of inventory. And then there is the mint situation, delays, backorders, bottlenecks. People hear delay and assume it is just staffing or shipping. Sometimes it is, but during a surge, delays are also a symptom of a market that is struggling to source enough raw material at the right price quickly enough to keep pace. When demand moves faster than supply chains, it appears as out of stock, backordered, allocation, and limit one. That is soft rationing. It is not a law, it is not a headline, but it is the beginning of a gate closing. Now zoom back out. Set the intraday candle aside. What did the system reveal today? First, it revealed fear because confident markets do not change rules mid-surge. Second, it revealed real demand because real demand bought the dip instantly. Third, it revealed strain in physical flows because inventory is moving out while paper price is being leaned on. And fourth, it revealed preparation at the highest levels because when officials talk critical minerals during a spike, they are preparing policy. This is why the price action you witnessed today is not bearish, it is a stress test. The house tried to slam the brakes, the car still moved forward. And here is where the story becomes a decision point for you. Because the next phase is not just about price, it is about availability. It is about whether the average person can still participate at reasonable premiums, or whether the metal quietly gets redirected away from public hands and into industrial and strategic channels. If you are holding physical silver, understand what you own. You're not holding a line on a screen. You are holding a scarce input to modern life. A system can push a paper price down for a day. It cannot print a mine. It cannot vote new ounces into existence. It cannot accelerate geology. And if you're not holding any, then you have to ask yourself something uncomfortable. Will you wait until the market makes it obvious to everyone? Because by the time it is obvious, it is usually expensive and inconvenient and sometimes unavailable. Now, this is where I want you to lean in because the next part is the part most people miss. When the exchange raises margin, it does create forced selling, especially among leveraged longs. That can generate sharp dips. Those dips can look like the end. And if you only watch the screen, you will be tempted to believe it. But the real story is written in behavior. Who buys the dip? How quickly does price recover? Do premiums fall with the paper price, or do they remain elevated? Do inventories refill, or do they continue to drain? Do delivery dynamics calm down, or do more players fight to stay close to the front month? Those are the questions that tell you whether the rally is fragile or unstoppable. And today's behavior was defiant. A punitive margin increase landed, a sharp dip printed, and buyers treated it like a gift. So, what is next? If paper tools cannot kill the move, the system will continue escalating in the areas it can control. Leverage, access, and narrative. More warnings, more expert takes, more attempts to frame every dip as a top, more reasons you are supposed to feel foolish for wanting metal. Because here is the truth. If silver is truly becoming critical again, the last thing powerful institutions want is a public that understands that early. They prefer you distracted. They prefer you in paper products you cannot redeem. They prefer you staring at a chart and believing the chart is the entire story. Meanwhile, the people with real need and real money keep pulling metal out of the system. Now, let us bring it home with a simple, brutally clear takeaway. Today was not about a $2 move. Today was about control. The rule change was not random. It was not routine. It was timed. It was targeted, and it was designed to send a message. We can still hit the price whenever we want, but the market sent a message back, not like it used to. And that is why this moment matters. When the old playbook stops working, the next chapters get wild. Because the system has fewer tools than it pretends, and the tools it has come with consequences. If they smash the price too hard, they accelerate physical drainage. If they allow the price to rise, they expose the shorts and invite more demand. If they restrict access, they confirm the shortage and ignite even more panic buying. Every path carries a cost. So here is my question for you. Do you think today's margin move was a one-time risk adjustment, or was it the opening shot of a longer campaign to slow this market down? And second question, be honest. If you saw silver surge toward $100 and retailers started limiting purchases everywhere, would you wish you acted when it was still easy? Share your thoughts in the comments because I read them and the patterns in what you are all seeing on the ground matter more than 1,000 headlines. And if you want updates like this, clear, fast, no fluff, make sure you subscribe to this channel. Short and simple. Hit subscribe now because this story is moving quickly and the next rule change could land when you least expect it. Because the empire tried to strike back today. The dip was bought, the vaults kept bleeding, the policy people started meeting, and the biggest clue of all is sitting right there on your screen. After everything they threw at it, silver refused to die. And keep your eye on the futures curve itself because it often whispers the truth before the headlines do. In a calm market, future months trade at a premium to spot because storage, insurance, and financing cost something. But when metal is scarce right now, that relationship can invert. Spot gets bid up, near-month contracts get tight, and suddenly the market starts paying you to take delivery sooner. That is not speculation. That is a warning light that the physical pipeline is strained. And watch the delivery behavior as well. When a contract month approaches expiration, most traders normally roll forward without drama. But when confidence fractures, some players refuse to roll. They want the front month. They want bars. They do not want a promise. And if enough of them make that choice at the same time, the exchange faces a nightmare. It must either source metal at any price or find a way to change the settlement terms. That is the cliffhanger nobody wants to say out loud. Higher margins are step one. Limits at retailers are step two. The next steps can become uglier. Position caps, tighter definitions of deliverable inventory, and louder encouragement to cash settle. So do not just watch price. Watch the rules, the premiums, and the waiting lists.